Hey guys, I get many questions from people who say things like, Ken, how should I build an investment portfolio? How much should I allocate to equities or bonds? What funds exactly should I be picking? So many questions tied to this one topic. But the truth is, it really depends on your personal circumstances. And more specifically, it really depends on what stage you're at on your wealth accumulation journey. So what I want to do with this video today is I want to outline for you 5 steps that you can take to help you build an investment portfolio. But what I want to do on the 4th point is I want to stop there and go deeper and then assess for you how exactly you should start to think about allocating your investments within your portfolio. So how exactly should you do your asset allocation? And more specifically, what should you be thinking about? Because these are the things that people often ignore because they're focused on what percentage and what funds. You need to really think about your personal circumstances based on kind of where you're at. And I want us to just take a deep dive on point number 4, and then we'll move on to point number 5 on this journey to help you learn how to build an investment portfolio. More specifically, I want us to look at 3 broad groups. So the early savers are those in their 20s and early 30s who are starting to save money and invest their money. Then you have the people in the middle, call them the midlife accumulators, who are typically aged from their mid-30s to around their late 40s or early 50s. And then you have the third group who are the traditional retirees who are typically aged from around the age of 55 and beyond. What we want to do on this video is to share with you specific things you should be prioritizing depending on what stage of your wealth accumulation journey you're on specifically. My name's Ken of the Humble Penny and Financial Joy Academy. What we do on this channel is give you guys the tips, the insights, the practical hacks to help you work towards a dream life of financial independence and money joy. Right, let's dive straight in and look at these 5 different steps on how to build an investment portfolio. Okay, so the first step is to decide how much help you want with building your investment portfolio. So there are around 3 choices that you have here. First is a DIY option, so do it yourself, where you build your investment portfolio by choosing the various components of your portfolio yourself. Then there's the robo-advisors in between, where you are asked questions about your risk tolerance and about your goals in order for you to then invest your money into a form of a ready-made portfolio. Then at the extreme end is where you can have a financial advisor do the work for you and make investment decisions on your behalf. Now, our approach personally is for you to learn how to actually invest your money yourself, because it's a life skill. And if you learn to understand this process, which honestly I can guarantee is really not daunting, just requires your attention. If you can learn the process and keep things simple, can't repeat that enough, keep things simple, then you can acquire the skill of the DIY of investing your money yourself and building that confidence to the point where one day you can then teach your family members or others around you how to do the same themselves. Now, this doesn't mean that you shouldn't go down the robo-advisor route, which some people prefer because it offers them a bit of a hybrid or perhaps even a starting point to start investing their money before they then go onto the DIY route. Or it doesn't mean you should not explore financial advisor necessarily if you've got a very complicated setup. Okay, if you have a complex situation, then a financial advisor might be the path for you. But our preference is the DIY route to learn how to actually invest your money and build your own portfolio. Stage 2 is to choose an account that will help you work towards your goal. So there are different types of investing accounts, and in order to build a portfolio, you need an investment account to begin that journey. There are various options, different forms of ISAs, then you have pensions and so on. We've made a video comparing specifically whether you should invest in an ISA or in a pension and so on. I'm going to put links below and above for you to head over and check that out. There are also other options such as a lifetime ISA and so on as options for you to begin this journey, again, depending on where you are on the journey. For some of you, you already own a home, in which case your main focus is then planning for later life, such as planning for retirement. But for other people, you might not own your first home. So your next big leap might be to focus on choosing an account that prioritizes that before you then prioritize other investments into, say, a stocks and shares ISA or into a self-invested personal pension, such as a SIP and so on. But do watch that video because that will help you at the very beginning stages choose the right account to begin building your investment portfolio. Okay, stage 3 is to choose an investment based on your risk tolerance or risk appetite. Okay, so now you've chosen an investing account. You now need to put some investments into that account. You should typically start by having some cash in your account, but obviously do not leave your money in cash in your investing account, such as your stocks and shares ISA. You actually need to have that money invested in some way, shape, or form. We've talked to you loads on this particular channel about our approach, which is a passive investing approach, is what we prefer as our preferred investment strategy. So I'm going to put, if you've not seen many of our videos related to this very topic, I'll put our really popular beginner video for how to start investing in the links below and above for you to go and check that out. That introduces you to the idea of exploring passive trackers such as index funds and ETFs as a way to get you started with actually beginning to make investments. For us, we prefer global focus, really broad-based index funds or ETFs because that reduces our risks tied to specific companies and gives us the best chance of getting the market's return by exposing our money to sufficient risk. But as you are here related to building an investment portfolio, the next step, which is step 4, is to then determine what asset allocation is best for you for your personal circumstances and your stage of the wealth accumulation journey. This stage of the video is where we're now going to take a deep dive and now look, as I mentioned earlier at the start of this video, at 3 broad groups and what I think you should be thinking about and prioritizing depending on where you are, specifically on your wealth accumulation journey or depending on what age group you belong to. Now, I'm using those age groups as proxies really just to make this video really easy and understandable. But it goes without saying that, someone who's quite young in their 20s or 30s could be quite further ahead on their wealth accumulation journey because they've made very good investment decisions and so on. So they could be quite well advanced. I'm going to keep this video really simple and assume that there are 3 broad groups: the early savers in their 20s and 30s and early 30s, the midlife accumulators in their mid-30s to their late 40s and early 50s perhaps, and then the traditional retirees who I'm going to assume aged around 55 and beyond. And for those 3 broad groups, I'm now going to share with you various things that I think you should prioritize in deciding how exactly you do your asset allocation in order to build your investment portfolio. Okay, so let's start with group 1, which are the early savers. So if you're in your teens or your 20s, all the way to your mid-30s thereabouts, you're considered to be kind of in that early savers group. My thoughts around this group really are that you should be focused here on exposing your money to as much risk as possible. Why? Because you have potentially decades ahead of you before you might actually require access to the money that you are investing today. Yeah. So you have the opportunity for the money that you've exposed to risk to potentially generate returns that will matter many, many years down the line. Okay, so you have that opportunity to see compounding really kicking. But converse to that as well, if you invested your money really early and exposed your money to as much risk as you can, then even if you suffered losses, you also have the time for things to kind of work themselves out over time. So my top tips if you're an early saver is: number 1, expose your money to as much risk as you can, but also be prepared to lose some of it. Number 2 is don't expose all your money just to equities. Do make sure you keep a small proportion of your money in the case of emergencies. Again, we typically say about 3 months worth of money in cash or near cash assets. Given today's climate, we'd probably say sensibly, you should aim to keep at least 6 months of accessible money in cash and near cash assets. Number 3 is to do the hard work of learning. This would benefit you so much if you are in your 20s and 30s. Focus on really understanding how all these vehicles work. So how do ISAs work? How do pensions work? What are the tax benefits of these various vehicles, because you see as we get to the next step, which are the midlife accumulators, you see that the key considerations for them will differ vastly to what you are potentially considering at this stage of your journey where you are building a portfolio. That learning in your 20s and 30s will matter a lot in helping you to build confidence to make sure that you are making the right decision for your money over the next 10 years ahead of you. The final tip for you early savers is to focus on really building the habit of saving. Nothing beats you sticking and committing to a decent savings rate of at least 20% of your net income every month, with a goal of building that habit of saving that money and investing that money, and over time with a goal of increasing that savings rate gradually as your income increases, as you advance in your career and so on. So those of you early savers, a sensible allocation could be something like 80% equities and 20% to bonds. Now, I'm not saying that that should be the only allocation. It's just a sensible allocation for you to consider and tweak as necessary depending on your personal circumstances. Okay, so the second group are the midlife accumulators. At this stage, you are typically around your mid-30s and heading towards your late 40s or even early 50s. You are at the prime of your career. You're possibly making the most money you'll ever make on your career journey. You potentially have a career trajectory ahead of you, and you have some ideas what that career might look like down the line. Key tips for you midlife accumulators. Number one will be for you to focus on taxes. You will find that tax will be such a huge consideration for you as you start to hit those higher level income brackets. And of course, that then affects what sort of vehicles you invest your money through in order for you to build your investment portfolio. You find that if you're a higher taxpayer, for example, it's in your best interest to put a lot more money into pensions, because over time it stands to potentially work really well for you because you're getting a greater proportion of your tax back by investing your money into pensions. But again, this of course is not a one size fits all, and you need to think about this from your own personal circumstances and let that then guide you in helping you build a suitable enough portfolio. The second tip here would be that you might want to slightly increase your allocation to bonds. Now, of course, equities still play a massive role for midlife accumulators, hugely, because your financial goals are possibly still quite far away from you in your mid-30s and possibly mid-40s. So equities still play a really, really important role, but you might want to consider a slightly increased allocation to bonds. But again, depending on what your tolerance to risk is and how far away you are potentially from your ultimate financial goals. The third tip, and this is a really important one, is to start to gain some clarity on how many more income generating working years you have ahead of you. This is an assessment a lot of people don't do. They carry on working, but they don't think to themselves, well, actually, how many more years am I likely to keep generating this sort of income I'm generating right now into the future? Assess how many more years that is, and that might then start to give you an idea of what sort of income you might require per month once you get to a point in the future where you might choose to retire. This is a particularly important point if you're somebody who would love the option of early retirement, or if you're somebody who might be working towards achieving financial independence. The time period that you see ahead of you is one that you have to be quite cautious about. In that if you think you've got 15 years ahead of you, I'd probably say be prudent and assume it's probably something like 10 years or 12 years, which might then mean that the amount of money that you are investing each month needs to be a lot higher in order for you at your assumed average rate of return over a time horizon. In order for you to then hit the income goal you're aiming for, you might need to then start to put more money away by you doing that. But without you spending the time and making that assessment of how many income generating years you have ahead of you as a midlife accumulator, you might not begin to think to yourself that perhaps you need to put some more money away and working for you in order for you to hit those life-changing goals down the line. So a sensible allocation, a really safe allocation if you're a midlife accumulator, could be a 50% equities, 50% bonds, but that's really, really safe, okay? A simple rule of thumb is for you to take the number of 120 take away your current age. Let's say you are 40 years old, for example. So 120 minus 40 is 80. That proportion, as a rule of thumb, again, a rule of thumb, might be your allocation to equities. So it might be 80% equities, 20% bonds. But really and truly, I'd say something that kind of sits between 50-50 and 80-20 would not be a bad shout if you're somebody who is at that midlife stage where you are working towards your goals, but you're also aware of the need to not expose all your money to risk, but to expose a sufficient amount of money to risk such that you generate enough returns to help you hit your goals down the line. Okay, so let's talk about now the third group, which are your traditional retirees. These are the people who are at the age of 55, thereabouts, and beyond. Yeah, so you have those who are around that age group, but don't have enough saved and invested to kind of last them for the many years that they might have down the line. Then you have a second group of people who have, more than enough and also need to invest their money for the years down the line. The approach that each of these two groups might have towards building their investment portfolios would be very different. Because the first scenario where you have somebody who is in that age group and that stage of their wealth accumulation journey, but hasn't got enough money, will be very different because their risk tolerance will be very, very different. They'll have a very low tolerance to risk, which might mean that that individual in that scenario will focus a great deal more on maybe exposing their money to as little risk as possible. Potentially expose more of their portfolio to bonds where they think about creating an investment portfolio. Their focus then would be outside of investment income. They then focus on things such as social security, looking at their state pension, looking at their work pension with their employer, and things like that, with the focus of determining how much income could come out of that, and the gap between what's there and what they need is what they will need to generate from them investing their money through the stock market. A simple rule of thumb for that first group would be for them not to spend more than 4% of their portfolio. Okay, so if you really keep to that as a rule of thumb and stick to that 4%, it will then help you then manage your lifestyle because you have an idea of what level of income you might expect to get back if you are starting to draw down your investments, i.e. 4% of your entire portfolio. If 4% equates a certain amount of money, then you want to make sure you're then managing your lifestyle to stay below that 4%. But for the second group that I mentioned, which are the people who have more than enough money to meet their needs, which are quite a small group of people actually, relative to most of the population who find themselves struggling to really save for retirement. For those guys, their focus really would be on passing their money to the next generation, potentially doing some estate planning and things like that to pass their wealth onto their children, potentially. And so their focus might not necessarily be to be risk averse. Even though they are later on in life, in their 50s and 60s potentially, those guys will find themselves potentially still exposing their money to sufficient risk, i.e. a much higher asset allocation to equities, because ultimately the goal is for them to pass that wealth on to the next generation because they've got more than enough to kind of help them live, but they want to pass that wealth on, and passing that wealth on to perhaps their loved ones, their children, and so on means that they potentially have a much longer time horizon, which means that exposing a high proportion of their assets to equities, which are much higher risk, would make more sense in that particular scenario. Okay, so that brings us to the end of step 4 of 5 on this journey towards building your investment portfolio. Step 5 is for you to then monitor your investments over time once you've created your portfolio and then rebalance as needed as time passes. Rebalancing might be necessary if you have invested, for example, largely in equities, and those equities go up a lot in value over time and therefore almost disrupt that balance between the proportion you have in equities and the proportions that you have in bonds when you started off your investment portfolio. So rebalancing is essentially the process that you go by to essentially bring back your portfolio to the original makeup that you had. So say, for example, you had 80-20 and that proportion had changed because that 80% had gone up over time. Rebalancing is what brings it back to that proportion of 80-20 that you began with when you created your investment portfolio. The thing to mention is that for quite a number of investments, you typically don't even have to do this rebalancing yourself. So for example, if you are invested through a robo-advisor, this is pretty much done for you. Or for example, if you invest your money through what's known as target date retirement funds, Again, this rebalancing process is done for you. A sensible interval to consider rebalancing your portfolio might be every 6 to 12 months. An alternative way to look at rebalancing is to consider doing it when a proportion of your portfolio, so say for example your equities, shifted above a predetermined percentage. Okay, so if you went over, say, 10% or 15%, you might then want to consider rebalancing your portfolio to bring it back by selling down some of those equities to bring down the proportion back to at around, say, 80% equities to 20% bonds, for example. This rebalancing exercise ultimately helps you to ensure that your investment portfolio matches your appetite for risk and ultimately gives you the best chance of achieving the average returns you need in order to achieve your financial goals down the line. Okay guys, so those are the 5 steps you need to walk through in order to build yourself an investment portfolio. The key thing to note is that the approach should be really simple. The more simplistic your approach is towards building a portfolio, the better. I'd highly recommend, once you've gone through this process, focus on the learning. If you're somebody who's trying to build yourself a simple global portfolio, if you get to that point where you are starting to choose specific funds for your portfolio, keep it really simple. You can find yourself choosing a maximum of 2 or 3 globally focused funds that give you sufficient exposure depending on what your desired allocation is for equities and bonds. But overall, this process shouldn't be complicated. Focus on really personalizing this process for yourself. Don't look so much at what other people are doing necessarily. Focus on making sure that you are making the right decisions for yourself, given your stage of the wealth accumulation journey. I hope you've really enjoyed this video today on how to build an investment portfolio. I'd love to hear from you in the comments. What other specific questions do you have when it comes to this idea of building an investment portfolio? What do you find complicated or challenging? Jump in the comments and let's talk about it. If you really enjoyed this video, I'd love for you to hit that like button as well as that subscribe button, because that just helps us continue to have more visibility and reach so many more people with our videos. Thank you so much for watching today's video. I'd love for you to make sure you share it with one other person at least. Check out to the side a few more videos we've made recently about how to invest your money and build confidence on your wealth building journey towards financial independence. Thank you so much for watching today's video. And as ever, in all things, be thankful and seek joy. Take care and bye for now.